I bought my first rental property in Seattle for $570,000 in 2017, which was rented for only $3,000 per month. That's a 0.52% rent to price ratio, which breaks almost all the rule I'm about to show you in this video. But it cash flows every month. It was one of the best investment decisions I have ever made because of what happened before the purchase and how I turned that single property into 6 rental properties after 4 years. Today I am breaking down 5 filter steps to analyze a rental property, 1% rule, 50% rule, calculate all the expenses, cash on cash return, and finally I will show you how to use my exact spreadsheet to analyze your next property. The 1% rule. Take a look at this. I am on Zillow right now and I'm going to pull up a listing. So in this listing, you will see the purchase price is for this property is $104,900, and I'm going down into the Zillow to find out what is the rent guesstimate. The rent guesstimate is $1,227 per month. So I take that $1,227 and divide it by 104,900 and I get exactly 1.17%. So basically this deal passes the 1% test. So what is the easiest way to calculate 1%? You take a look at the price, remove the last 2 digits, so you get like $1049. So if you get $1049 per month rent, that means it passes the 1% filter. Now watch what happens with this one. $330,000 property. Look into the rent estimate. Rent estimate is $1,764 per month. And if you divide by 1764 with the purchase price, $333,000, you get only 0.53%. Half of what we need. I don't even open the listing. I move on because these will not meet 1% rule. The math behind why this works is straightforward. At 1%, you are collecting enough rent that after expenses, there's a real chance something is left over. Below that threshold, the rent to cost ratio is so compressed that expenses eat everything before your mortgage even gets paid. It's not a guarantee of cash flow, it's a guarantee that the deal is worth looking at more closely. Before moving to 50% rule, if you want my help in building your real estate portfolio like mine, check out my mastermind program, link in the description below. 50% rule. Once a potential deal passes the 1% filter, the next question is whether the rent can actually cover the mortgage. And this is where a lot of first-time investors make a mistake. They look at the rent, look at the mortgage payment, see a gap, and assume that gap is profit. But it isn't. Here's the number. I call it half income. I use before I touch a spreadsheet. Take whatever rent the property collects, divide by 2, so it is half income. That half income is for taxes, insurance, maintenance, vacancy. It disappears before your mortgage sees a single dollar. So if you are collecting $2,000 a month, you have got $1,000 left for debt service. If your mortgage is $1,400, you are short of $400. That deal probably doesn't work as a straight rental. But if you are house hacking, living in one unit, and collecting $1,000 from the other, you are only out $400 a month out of pocket. That's less than most people pay for a parking spot in a city. Brandon Turner, who built Bigger Pockets into the largest real estate investing community in the world, put this rule in writing back in 2013. It's been used by hundreds of thousands of investors since because it's fast and it's almost always right. Think of it like a pressure test. You are not trying to dig into the details yet. You are trying to find out if the mortgage is even survivable on the rent coming in. If the 50% rule shows you are underwater before you are even accounted for debt service, the full analysis is going to confirm it. You have just saved yourself an hour. Run it on every deal that passes the 1% rule. Take the monthly rent, divide it by 2. That's your estimated expense load. Subtract it from the rent. What's left? Can it cover your mortgage? If yes, keep going. If not, move on. Breaking down the numbers. The 1% rule, the 50% rule are quick filters. They tell you which deals might be worth a closer look. Now, the third level is where the real analysis happens. Because the investors who lose money on rental properties aren't bad at finding deals. they are bad at seeing the full picture. I want to walk you through a property I analyzed. This is a single family home, 3 bed, 2 bath, low cost of living market, 104,900 is the purchase price. And we already know the rent price is 1,227 for this. Here's the every dollar going out each month. So I will take you to mortgage calculator. I will put down all the prices here, 104,900. You put 20% down and your loan amount is $83,920. With 6% interest rate, you are paying close to $708. To find out the property and insurance, you can get a insurance estimate from a insurance agent or online. And you can also take a look at the taxes for this property. I can see 1,326. So let's go one by one. So you are paying for mortgages $708 per month. You are paying taxes $110 per month. The home insurance, I'm assuming $66 per month. You still need to pay the property management fee at 8%, which would be $98. Vacancy reserve at 4%, $49. Maintenance reserve at 5%, $61. Capital expenditures reserve at 3%, $39. So total monthly expenses $1,132. Rent coming in $1,227. So after all the expenses, your cash flow is only $95 a month. So annual cash flow is $1,140 per year. The line that surprises people most is CapEx, capital expenditure. That's the roof, the HVAC, the water heater. Things that don't break every month but cost thousands when they do. If you don't reserve for them, the first time a furnace goes out, it wipes out 6 months of cash flow in a single afternoon. The reserve doesn't feel like an expense until the day it saves you. Cash on cash return. Cash flow tells you how much money a deal puts you in your pocket every month, but it doesn't tell you whether that deal is a good use of your money. For that, you need one more number. Let me show you using my cash on cash spreadsheet. If I want to buy a $150,000 property, in my spreadsheet I put down the purchase price $150,000. I need some other expenses as well, like down payment, closing cost, renovation. Total cost is $38,000 if I want to buy this property. I will explain this spreadsheet later in the video, but what you find out that if you put monthly rent $1,500 for this purchase price $150,000 property, after all the expenses, you get the cash on cash return is 9%. So what do I mean by that? So if you are putting total $38,000 in the closing table, and if you are getting after all the expenses income is $291 per month, you divide the number for the year and divide it by the total cash, so you get 9%. So that's your actual cash on cash return. Means you put up $38,000, you are getting back $290 per month. The percentage of my invested capital that comes back as cash flow every year. Now compare that to the Vanguard S&P 500 index fund, the benchmark most people use for passive investing. Average annual return over the last 30 years, you will see around 10.24%. If you compare it with our just analysis, the cash flow, it's almost like 10%. But cash flow is only one of 4 ways this property makes money. The tenant is also paying down the mortgage, about $2,400 in principal every year. The property is appreciating at a conservative 3%. That's $4,500 a year on a $150,000 asset. And the IRS lets you depreciate the structure, roughly $4,000 a year in a tax write-offs. Add all 4 things together and the total annual return on that $38,000 close to 20%. The reason cash on cash matters is that it makes deal comparable. You can't compare a $150,000 property to a $300,000 property just by looking at the cash flow. One might produce $290 a month and the other is $500. But if the second one required $80,000 to close, the return is actually worse. Cash on cash return puts everything on the same scale. It answers the only question that matters. For every dollar I put in, how many dollars come back? Set your floor at 8%. Any deal that comes back below that, negotiate the price down until it clears 8%. or move on. House hacking. Everything I have shown you so far assumes you are buying as an investor with 20% down payment, standard loan terms based on full market rate. That's $38,000 to close on a $150,000 property. For a lot of first-time buyers, that numbers is the wall. House hacking is how you get around this one. My first primary residence was in Redmond, Washington, a market that faced the 1% rule completely. I bought it with a conventional 5% down loan, owner-occupied financing, because I was going to live there. I moved into the house, I rented out the basement, the tenants covered the half of the mortgage. In a market where a straight rental investment would never cash flow, I was living for half of the mortgage and building the equity every month. That's what owner-occupied financing unlocks. As an investor, you need 20 to 25% down. As an owner-occupant, you can use a FHA loan at 3.5% down or conventional at 5%. On a $150,000 property, FHA drops your down payment from $30,000 to $5,250. Total cash to close falls from $38,000 to roughly $13,000 to $15,000. That's the difference between needing years to save and being able to move in just 12 months. The reason this works is that the loan program is designed for people who live in the property. The bank takes on less risk when the owner is on site, so they offer better terms. You are not gaming the system, you are using it exactly as it was built to be used. Live in one room or one unit, rent out the rest, let the rent offset your housing cost. After 12 months, you can move out, convert your unit to a rental, and do it again on the next property. Each cycle, you are building a portfolio with a fraction of what a traditional investor needs. If you are buying your first property, this is the move you should do. Find a duplex, triplex, or a 3-bed single-family home. Get pre-qualified for an FHA or conventional owner-occupied loan, 2 or 3 lenders. 20 minutes each, it's free. Apply the 1% rule. Run the 50% check. Break down the full numbers. If the deal clears 8% cash on cash, make an offer 10 to 15% below asking. Move in, rent the other rooms. In 12 months, you have got a cash flowing rental and you are ready to do it again. The ROI spreadsheet. Every number I have walked you through, the expenses stack, the cash flow, the cash on cash return, you can calculate all of it by hand. But when you are running 5 or 10 deals at a time, doing it manually slows everything down. This is the tool I built to fix that. I'm going to open the spreadsheet right now and run the $150,000 deal through it live. There are two numbers. So if you put $150,000 here, it automatically calculates the down payment 20%, also the closing cost 4%, and you put the another number in this blue shaded cell, $2,000, the renovation cost. So it automatically calculates your total cash investment or cash required to close is $38,000. So you only need to put these two values, the purchase price and also the renovation, and you get $38,000 automatically, the cash to close. Section B in the second column is the monthly expenses. So to calculate monthly expenses, you need to go to the mortgage calculator. You put down all the numbers here, 150,000, and what is the interest rate. You calculate using this button. You get the total monthly payment required. And you put this mortgage payment in this box. Then you find out the tax and insurance and put the monthly tax and insurance payment in this column. So for this property, I'm assuming this is $150. Mortgage payment was $759. So for the expense column, you only put down two things, the mortgage payment and also the tax and insurance. Then you go to Zillow and find out the rent estimate for this property. If it's $150, it automatically calculates all the property management fee, vacancy, maintenance, and capital expenditure. So after all these things, you get the total expense of this value. So total monthly expense become $1,209, and this part is actually the cash on cash return. This is 9%. That's the number you want to look at. So this is the real power of this spreadsheet. You put out only 5 numbers, you calculate everything automatically. So you put the purchase price, you put the renovation cost, you put the monthly rent, you put mortgage payment and tax and insurance. Those are the 5 variables, and you get all the values, cash on cash return 9%. The real power of the spreadsheet isn't running one deal. It's running 10 deals side by side. You pull up 10 listings that pass the 1% rule, drop each one into the spreadsheet, and within an hour you have got a ranked list by cash on cash return. The one at the top gets your offer first. The ones that don't clear 8% go in a folder for when prices drop or you can negotiate harder. The link to download the spreadsheet is in the description. Open it, run the next deal you find on Zillow through it, section A, section B, and section C. If the cash on cash comes back at 8% or above, that deal is worth pursuing. If it doesn't, you just saved yourself from a bad investment in about 2 minutes. That's the skills. That's what puts you ahead of the people who buy on gut feeling and find out 6 months later the number never worked. If you like this video, you would love my mastermind program where I teach all these analyses and help serious investors build true wealth. The link is in the description below.